If you have been investing in the stock market for many years, you probably have made some investment mistakes before, and we all know that the mistake can be very painful to learn, especially if real money is involved. We remember these lessons for life because they are very expensive to learn, but if you're new to investing, you probably have no idea what I'm talking about. Okay, but you still want to pay a serious attention to this video because I always wish that I know some of these investment mistake lessons early when I first started out investing. I will probably have saved tons of money by not repeating the same mistake again. So in this video, I'm going to share with you some of my personal investment mistakes when I first started out investing and some of the common mistakes that dividend investors made and you want to avoid them. One of the most common mistakes that investors make is to invest based on stock tips. I attended some very expensive seminars 10 years ago and I paid $4,000 to attend this seminar. So during the seminar, I learned this particular stock tips called Courage Marine. Don't bother trying to search for this company because you can't find their name anymore. Basically, this is the company that does dry bulk shipping, those big ships that carry commodities from one destination to another. So I bought this company thinking that the stock tips given by the so-called expert could have made me money, but I was so wrong, right? So and I lost a few $1,000s from that investment. And looking back now, I have since learned that shipping industry is just a bad industry to be in. It is an industry where there's no differentiation between one player versus the other. So it is very difficult for them to make money, and it took me 6 years to learn these lessons. Again, the point here is you do not want to listen to stock tips from the so-called experts and follow them blindly, because this is the repeating patterns that not only happened to me, I've also seen the same mistake repeated by my friends. So I have few friends who invested and lost a lot of money because one of them got their stock tips from his stockbroker. I'm not saying that all brokers are bad, but that's just how most investors get their stock tips from in the past. Okay, so you give them a call, they tell you what hot stocks to buy. Nowadays, you probably get your investment ideas from somewhere else, right? It could be a YouTube video like this, a blog post, newspaper, and so on and so forth. And if you follow some of these stock tips, and when you are lucky, you make money, but I hear people losing money most of the time. Okay, so who is at fault here? Is it a broker? Is it the YouTube video that you watch? Or is it you yourself? Okay, it doesn't matter because the money is already lost. Okay, what matters the most is you do not want to repeat the same mistake again and again. So always do your homework and make sure you are comfortable taking on the investment with the risk that comes with it. The second and the most common mistake that dividend investors make is they focus only on high yield dividend stocks. When we buy income stock, we want to have a decent yield, right? We want to make money, more and more money. So it makes sense to look at a yield, especially the one with higher yield, right? You might want to think twice because you could get yourself into serious trouble when you start to focus too much on dividend yield alone. Why? The answer is simple, right? Yield doesn't tell us anything about the sustainability of the dividends, right? If you look at the formula for dividend yield, it is the dividend per share over share price. As you can see here, this formula doesn't tell us anything about the sustainability of the dividends. The formula just shows us how much the company has paid out their historical dividends and what yield we can expect on the price that we are going to pay. It doesn't tell us whether the company can continue to sustain the same amount of dividends moving forward. So if you are just looking solely based on the stocks that have high yield, you may end up looking at the list of companies that could potentially cut their dividend. From my experience of picking income stocks, a lot of high yield dividend stocks come with higher risk. Okay? They are either going to cut their dividends or pause dividends altogether. Let me give you an example. Back in 2011, I have a lot of people telling me to look at Singapore Post. This is a company that was giving out a very attractive yield of more than 6%. It was considered a blue chip company. Blue chip companies are very popular among dividend investors because they are well known, well established, and they have been paying very good dividends in the past. So it can't go wrong, right? Plus, Singapore has a monopoly when it comes to mail business here in Singapore. Not email, but traditional mail. So it's quite obvious that mail business has been disrupted today, and Singpost share price has also come down. But back then, it was a hot stock, especially after Alibaba took a big stake in them. Okay, so the same thing for those people who are looking out for high yield perpetual securities like HighFlux. Okay, if bought into HighFlux, you probably will have to write that investment off today. Okay, so and the most recent one is this company that I have come across that have a very high yield is this company called Royal Dutch Shell, the owner of Shell petrol station, and their yield were trading at more than 10% at one point in time during the COVID-19. Do you want to get some of these shares? And in fact, they have just announced they're going to cut the dividends, and the share price of the company hasn't been doing so well. Okay, so don't just focus on yield. You need to look at the business and ask yourself whether the business will stay relevant in the next 10 to 20 years. Okay, and some businesses may also be disrupted or affected because of the crisis. Okay, so you don't want to focus too much on the yield, right? So those high yield stock, you want to stay far away because they are the one that likely going to cut the dividends or pause the dividends altogether. Another common mistake that dividend investor make is to use a stop loss strategy. Basically, this is a strategy where if you buy a stock, you want to limit your losses in the event when the market is going to have a big crash like the one that we have seen during COVID-19 or 0809 crisis. Okay, so stock prices during this kind of period can easily drop between 30% to 50% in a very short period of time. So the whole idea of having a stop loss strategy is to protect your downside, then you will not lose too much money. Okay, so now this principle makes a lot of sense if you are doing trading because the market can be very volatile in the short term, but it doesn't make any sense if you're investing for income for the long term. Why? When you sell a stock, you are no longer a shareholder of the company. Okay? When the company declares the dividends, you don't receive them anymore because you're no longer the shareholders. That's why as income investors, we do not use a stop loss strategy. Of course, you can tell yourself things like, I can always buy back after the market crash at a much cheaper price and a much higher yield. Okay, so stop loss strategy will still make sense, right? Well, good luck for that. When someone tells me this statement, I know he or she is likely going to make the next mistake, and that is to trying to time the market. It is a mistake that I personally repeated myself, and I experienced this firsthand when I was trying to time the market during the Euro debt crisis back in 2011. So back then the market was really bearish, and there was simply a lot of bad news surrounding the Greece debt level. So everyone was so worried that the Greece will potentially default on its debt and send the shockwaves across the world. So there were a lot of fears at the time, and when I was looking at my portfolio, the majority of my gains were literally wiped out. Okay, so investors around the world were very scared, and they all started selling out their shares. In fact, that period was the best time for me to invest, but unfortunately I didn't, right? So looking back, I realized that there was some sort of fear that I was experiencing, and I was trying to time the market. I actually told myself that I will buy once the Greece default on its debt, but who knows, they got bailed out and the rest is history. But actually back then, if you were to look into the news, in the media, what economists and analysts were saying, they make a lot of sense that the Greece would default on its debt. And I was so convinced and buy into their stories. Unknowingly, I was essentially trying to time the market with their opinions. One thing I've learned from this saga is that market is still the market. Okay, they are consistently unpredictable. The next common mistake that dividend investors make is trying to check the prices every day. So investing can be very emotional, especially in times when the market is very volatile. So when you start to check stock prices every day, what you're trying to do is you're trying to give yourself assurance that the stock that you have picked are a good stock. If the stock prices goes up, you tell yourself that you are right. If it goes down, you tell yourself that you have invested in the wrong company. So when you start to have this kind of thinking, you ended up buying high and selling low because you convince yourself that the stock is wrong, therefore you need to sell them. Okay, so you see, that's why most people got it all wrong, because they are checking the wrong stuff. Okay, so just ask yourself this: if you're investing for income, you should be checking on the fundamental of the stocks and not the stock prices, right? You want to check whether the stock can continue to pay the same amount of dividends, because this is what matters to you the most. So how do you do it? You want to find out whether the company is making good profit. You want to find out if the business is a good model to begin with. You also want to check if their payout ratio is sustainable, and you want to make sure the company is not taking on too much debt. So all these are important, and they are the one that will affect the dividends of the company. If the dividends goes up, eventually the share price will follow the suit. So that's how income investing works, And if you're interested to know how you can build a 5 to 6 figure dividend portfolio within 5 years, I will spend another hour with you on how to do it. You can check out at theincomestrategies.com, and I'll link it up in the descriptions below. So in the nutshell, you don't check stock prices every day. You have to check the fundamentals of the company. And I think Warren Buffett summed this up the best, and he once said that you should buy something that you'll be perfectly happy to hold it if the market shut down for the next 10 years. Alright, let me wrap it up with the last common mistake that investors make: not having sufficient diversification in the portfolio. I met a few investors before, and I find it worrying whenever they told me that they are very concentrated in one single sector. I still remember this particular guy. He is in his early 60s, sort of retired, and he relies on passive income from his investment portfolio to sustain his lifestyle. When he showed me his portfolio, I was shocked because all the stocks that he bought were essentially REITs. Okay, and I asked him, do you know that REITs is also a sector that uses a lot of leverage? Alright, REITs borrow money to invest in commercial property, and that will expose them to interest rate risk. So in the environment when the interest rate were to rise, REITs tends to underperform and vice versa. So you wouldn't want to see your portfolio goes up and all of a sudden it goes down because of the heavy concentration in one single sector. Okay, so diversification is one of the effective strategies to reduce the risk in your portfolio. You want to diversify your money across a few resilient industries such as utility, REITs, FMCG, etc. Right? And with that, I hope you find this video useful and you're listening from fifth person. If you enjoyed this video and you're new to this channel, make sure you click on the subscribe button to get notified for more videos like this in the future. And if you have made any investment mistake that I didn't cover in this video, please share it with me in the comments below so that I can learn from you and everyone else watching this video can also learn from you. Alright, thank you, and I will see you in the next video.